Hello again, traders. In our previous videos, we've covered the basics of CFDs, how they work, and the essential concepts of leverage, margin, and spread. Today, we're going to compare CFDs with traditional trading. Understanding the differences between these two approaches is crucial for choosing the right strategy that aligns with your goals. Let's dive in. First, let's define traditional trading. In traditional trading, you buy and own the actual asset, whether it's a stock, bond, commodity, or any other financial instrument. For example, when you buy shares of a company, you become a shareholder, owning a piece of that company. You can hold these assets for as long as you like, and you can benefit from dividends, interest, or price appreciation over time. Traditional trading often involves long-term investment strategies, where you might buy and hold assets with the expectation that their value will increase over months or years. You also have the potential to benefit from dividends or interest payments, which can add to your overall return. Now, let's quickly recap what CFDs are. As we discussed in our earlier videos, CFDs, or contracts for difference, are financial derivatives that allow you to speculate on the price movement of an asset without actually owning it. With CFDs, you can profit from both rising and falling markets, thanks to the ability to go long or short. However, you don't receive dividends or interest payments directly, and you're subject to different costs like spreads, commissions, and overnight financing charges. Let's break down the key differences between CFDs and traditional trading. 1. Ownership. In traditional trading, you own the underlying asset. This means you have shareholder rights such as voting and receiving dividends. In CFD trading, you do not own the asset. You're trading based on the price movement of the asset, without any ownership rights or benefits like dividends. 2. Leverage. Traditional trading usually involves buying assets outright, requiring the full amount of capital up front. Leverage is available through margin accounts, but it's typically lower than what you'd find in CFD trading. CFD trading, on the other hand, offers high leverage, allowing you to control larger positions with a smaller amount of capital. This can amplify both your profits and losses. 3. Going long versus short. In traditional trading, going short often involves borrowing the asset, selling it, and buying it back later. This can be complex and involve additional costs. With CFDs, going short is straightforward. You can easily profit from falling markets by selling a CFD position. 4. Costs. Traditional trading costs may include brokerage fees, transaction fees, and possibly taxes on dividends or interest. CFD trading costs include the spread, commissions, depending on the broker, and overnight financing fees if you hold positions overnight. 5. Trading hours. Traditional trading is often limited to market hours, which vary depending on the exchange. CFDs typically offer more flexible trading hours, allowing you to trade even when the underlying market is closed, particularly in the case of Forex or cryptocurrencies. 6. Market access. Traditional trading may limit you to specific markets based on the broker or exchange you're using. CFDs offer access to a wide range of global markets, including indices, Forex, commodities, and cryptocurrencies, often from a single platform. Let's weigh the pros and cons of each approach. Traditional trading pros: ownership of the underlying asset, potential for dividends or interest income, less risk of losing more than your initial investment, without leverage. Traditional trading cons: requires more capital up front, limited ability to profit from falling markets, higher costs for short selling and lower leverage. CFD trading pros: high leverage allowing greater market exposure with less capital, ability to profit from both rising and falling markets, access to a wide range of global markets from a single platform. CFD trading cons: no ownership of the underlying asset, potential for significant losses due to high leverage, costs such as spreads, commissions, and overnight fees can add up. So, which approach is right for you? It depends on your trading goals, risk tolerance, and investment horizon. If you're looking to build long-term wealth, own assets, and receive dividends or interest payments, traditional trading might be the better choice. This approach is often favored by investors with a longer time frame who are less concerned about short-term market fluctuations. If you prefer a more active trading style, want to capitalize on both rising and falling markets, and are comfortable with leverage, CFD trading might suit you better. This approach is often used by traders who are looking for short-term gains and are willing to take on higher risks for potentially higher rewards. Risk tolerance. Consider how much risk you're willing to take. CFDs with their high leverage can lead to significant losses, so they're typically more suited for experienced traders or those who have a solid risk management plan in place. Capital requirements. Traditional trading generally requires more capital up front, while CFDs allow you to start with a smaller investment due to leverage. However, the potential for loss with CFDs means you should only trade with money you can afford to lose. And that's a comparison of CFDs versus traditional trading. Both methods have their unique advantages and drawbacks, so it's essential to choose the one that aligns with your trading style, goals, and risk tolerance. In our next video, we'll dive into the pros and cons of the various markets you can trade with CFDs, from stocks to commodities, forex, and more. So make sure to subscribe and hit the notification bell so you don't miss out. If you found this video helpful, give it a thumbs up and share it with others who might benefit. And don't forget to drop any questions or comments below. I'd love to hear your thoughts and help where I can. Thanks for watching, and I'll see you in the next video.